talk about the last strategy, and that's the ETF option strategy. And our third trade management rule is to use the 30% rule for protecting profit. So if we have a 30% profit in a call option, then we'll sell a call option with a higher strike price, and that creates an option debit spread. So if we buy a call option, we have a 30% profit, then we'll sell a call option with a higher strike price, and that creates what's called an option debit spread. And if you purchase an option and then you have a 30% profit, the sale of the call option at a later date will increase the profit potential of the existing option purchase and will also provide downside protection in the event the underlying stock or ETF decreases in price. So you accomplish two things when you create these debit spreads. You increase the profit potential of the existing option purchase, and it also provides downside protection. We'll show you some examples of that. So when you have a bullish debit spread, the call option purchased will profit if the price of the stock increases, and the call option sold will profit if the price of the stock or ETF decreases, and then your risk is limited to the cost of the spread. So let's look at an example. We bought the XLU 42 strike call at 474. So this shows we own the September 42 strike call at 474. So we had a profit in that, and then at a later date, we sold the XLU 48 strike call at 190 to create an option debit spread to protect the profits. So again, sold the September 48 strike call at 190. So bought the 42 strike call at 474, sold the 48 strike call at 190, and we have when we did that, when we sold that 48 strike call for 190, $190 in cash went into our brokerage account, and that increased the profit potential of the 42 call that we already own. So when we sell the 48 strike call short at 190, that increases the profit potential of the existing 42 strike purchase. And it also provides downside protection if the ETF declines in price. And we have an option call option spread calculator, and again, this will calculate the profit potential for the option spread, assuming various price changes in the underlying ETF at option expiration. In this example, from the 7.5% increase in the price to a 7.5% decrease in the price at option expiration. So again, with XLU trading at 50.32, we bought the 42 strike call at 474, sold the 48 strike call at 190. So we can see that if XLU is flat at option expiration at 50.32, we're going to realize a $316 profit on the spread, and that represents 111% return. So, so in this case, we can profit on XLU if it is flat at expiration, we'll get 111%. If it goes up at all, we'll get 111% return for the spread. And if it goes down 2.5%, we'll still have a profit of $111 or 111%. And if it goes down 5%, we have 104% return. If it goes down 7.5% to 46.55, we'll still have a profit on the spread of 60%. So in this case, we had a profit in the 42 strike call, sold the 48 strike call, and that increased the profit potential of the 42 strike purchase, and also at the same time provided downside protection. And you can see that if its stock goes up at expiration or is flat, or is even down 2.5%, then we'll still get 111% return, which is a great return for the utility ETF. And even if it's down slightly at 5%, 7.5%, we'll still realize a profit on the trade. So in this example, creating the spread increased the profit potential and also reduced the risk. Here's another example. This is for the QQQ. Bought the 100 strike call at 779, and then we had a profit in that trade, so we sold the September 109 call at 440. So again, we bought the 100 strike call 779, and we sold short the 109 strike call at a later date at 440. So let's look at the risk profile on this, and we can see the call option spread analysis on this one shows if the QQQ is flat at expiration, we get 165% return. If it's up at all at expiration, 165% return. And then if it goes down 2.5%, we get 133% return. If it's down 5%, we still get a 51% return. And then if it goes down 7.5% at 102, then we will realize a loss on the profit. So in this case, we do, the spread does provide some downside protection, and also we get a great return if the index is even flat at option expiration. We'll get 165% return. So that's another example of we had a profit in the 100 strike call, sold the 109 strike call at 440. So that increased the profit potential for our existing purchase and also gave us downside protection. Okay, and this is our current portfolio, and in this we have ETF option purchases, and we also have the spread trades. You can see the 100 strike, 109 strike, QQQ spread right here, the VNQ, the 70, 83 strike spread. So we create these spread trades whenever we have a profit in our option purchase. So just to recap, the spread trades, they increase the profit potential of the existing option. They provide downside protection, and they can reduce your risk because when you sell a call option, that reduces your risk. So on the realty income spread, the cost of the call option purchase was $879, but after we created the spread, our total risk was $429. On the QQQ, we purchased the call option at $779. After we created the spread, our risk went down to $339. So it reduces your risk, and it can be profitable if the stock goes up or down, and you're limited. Your maximum loss is always limited to the cost of the spread.